Have you ever seen the perfect setup on the 1-minute chart, but suddenly the market moved in the opposite direction? You're not alone. Most traders lose because they only look at one time frame, and that's where everything goes wrong. Smart money never does that. They build their entire bias on the higher time frames and execute only with precision on the lower ones. In this video, I'm going to show you exactly why multi-time frame trading works and how to use it the same way professionals do. And stay with me until the end, because I'll show you how a single 1-minute confirmation can turn a normal trade into a sniper entry. Section 1. Why multi-time frame trading matters. The market is fractal, and every small move you see on a lower time frame is just a zoomed-in piece of a much bigger structure. If you only trade the 1-minute or 5-minute chart, it's like driving a car while only looking 2 meters ahead. You're going to miss what's coming. Higher time frames give you the real trend, the full liquidity map, your high-value order blocks, and the actual direction smart money is moving the market toward. Once you understand the higher time frame, the lower time frame stops looking random. It becomes a zoomed-in version of the exact same story. Section 2. The 3-time frame model. This is the simplest and most universal model. Higher time frame, or HTF, is where you find direction and liquidity. This is usually the daily or 4-hour chart. Here, you want to know two things: where smart money is pushing the market and where the next major liquidity target is. Mid-time frame, or MTF, is usually the 1-hour or the 15-minute chart. This is where you confirm structure, wait for a break of structure or a change of character, and identify high-probability reversal zones. MTF tells you if we're actually reversing or if the move is just a pullback. Lower time frame, or LTF, is where entries happen with precision. This is usually the 5-minute or 1-minute chart. Now you're looking for mitigation of MTF zones, clear BOS or CHOCH, liquidity setups, confirmation setups, and a clean order block to execute from. This is where your highest risk-to-reward trades come from. LTF is the place where you refine everything the higher time frames told you and wait for the market to give you that exact moment to pull the trigger with precision and confidence. Section 3. How to build a trade using all 3 time frames. Here's a simple step-by-step process. Step 1. Start on the higher time frame. Identify the main trend and the next liquidity target. For example, HTF is bullish, and the next liquidity is above this double top. Step 2. Drop to the mid-time frame. Wait for structure to align with your HTF bias. If the HTF is bullish while the MTF is bearish, you are not allowed to enter. Wait for the MTF to show a BOS or CHOCH in the bullish direction and form valid order blocks that match the higher time frame direction. Step 3. Drop to the lower time frame. Wait for the MTF order block to get mitigated, and then look for liquidity setups or a confirmation entry before entering the trade. Only after the mitigation and confirmation should you execute. Now let me show you the exact model I personally use for intraday trading. Section 4. The 3-time frame model, backtested version. Most traders use multi-time frame analysis in a very general or vague way. But after backtesting hundreds of trades, I discovered a clean and repeatable structure that works consistently across different market conditions. The model uses 3 specific time frames: 15-minute, 5-minute, and 1-minute. These 3 create the perfect balance between trend, precision, and execution. On the 15-minute time frame, you identify the main trend, whether it's bullish, bearish, or shifting, and you mark your major high-value order blocks. These 15-minute order blocks are your primary high-probability reaction zones. But you are not entering trades here. You are only defining where the market is expected to react. Then we move to the 5-minute time frame. This time frame increases the number of valid setups. Here, you mark the additional order blocks that form during pullbacks. These 5-minute order blocks give you more flexible trading opportunities while still respecting the 15-minute bias. Finally, we drop to the 1-minute time frame, where the actual entry happens. Once the price taps a 15-minute or 5-minute order block, you drop down to the 1-minute chart and wait for your confirmation. This includes a CHOCH or BOS, a confirmation entry model or a liquidity sweep entry model, and a strong 1-minute order block formed from a displacement. This is the level that gives you true sniper entries, extremely tight stop losses, and massive risk-to-reward ratios. Section 5. Practical example of the 15-5-1 model. Let's go through a real example so you can see exactly how the structure plays out on the chart. Step 1. Start on the 15-minute chart. On this time frame, we identify that the overall trend is bullish. A bullish order block has formed, and liquidity is resting above previous highs, which becomes our final target. Price begins to retrace toward the 15-minute order block, and this becomes our primary reaction zone. Step 2. Drop to the 5-minute chart. Now we zoom into the 15-minute pullback. On the 5-minute chart, we identify a refined bullish order block inside the 15-minute order block. This gives us an additional refined zone to work with, meaning we now have two high-probability reaction points, the 15-minute major order block and the 5-minute refined order block inside it. Step 3. Entry on the 1-minute chart. Price taps into the 15-minute order block. On the 1-minute chart, we wait for confirmation. First, we look for a strong CHOCH where a bullish candle breaks structure upward. Then comes the liquidity setup that often forms right after the CHOCH. Next, the displacement creates a strong 1-minute order block, which becomes our entry zone. We place our buy order on the tap of the 1-minute order block, with a stop loss just 2 pips below the entry. This creates a highly refined, high-risk to reward setup. Final outcome. The market sweeps liquidity, mitigates the 1-minute order block, respects the 15-minute order block, and follows the 15-minute trend and liquidity direction. This is exactly how the backtested 15-5-1 model produces clean, consistent, high-probability setups. Final summary. The 15-5-1 model keeps your entire analysis simple and extremely precise. On the 15-minute time frame, you find the main trend and mark your major order blocks. On the 5-minute time frame, you refine those zones with additional order blocks. On the 1-minute time frame, you wait for confirmations and execute. When all 3 layers align, the 15-minute direction, the 5-minute refined structure, and the 1-minute confirmation, you get a clean, high-probability setup with tight stops and clear directional flow. This is how smart money builds trades. And this is exactly how you should approach intraday setups using the 15-5-1 model. If you found this helpful, make sure to hit the like button. Then practice this setup on a demo account, and you will see clear improvement in the quality of your entries.